I want to talk about today are deferral adjusting entries. The reason we have adjusting entries is because if we didn't, our financial statements really wouldn't be up to date. Like when we buy supplies at the beginning of the year, we do not have the same balance in that asset account because we've used some. So a lot of times what I like to say, adjusting entries are the entries to show what we used. All we're going to talk about in this lecture is the type of adjusting entries when the cash is on the table and we're I don't like to use the word defer. Yeah, we do. We're deferring the event. In accrual, we're deferring the money, or we're accruing that pile of money. By definition, as it lists, deferrals are expenses and revenues. Now remember, every type of adjusting entry is either an expense or a revenue, and half of it is on the income statement, the other half of the transactions on the balance sheet, or impacts those kind of accounts. But by definition, they're either expenses or revenues that are recognized at a date later than the point when the cash was originally exchanged. So the money is at the table, we're deferring the event. They are either prepaid expenses or unearned revenue. Unearned revenue, of course, is a liability account. Typically, we know that liabilities are when we owe someone. What do we owe in this case? Not money, an event. We owe the work to be done. Okay. Now, this gets really confusing, and so I'm going to really work hard to simplify this. We're talking just about prepaid expenses now. Nothing to do with money coming in, revenue. This is money that we are paying out. So some examples are insurance, our supplies. Those two are both assets. Let's stop and talk about just those two for a minute. If I go buy a one-year insurance policy on my car, an auto insurance policy, okay, I own that 1 year worth of that asset to protect myself and my car. As I drive that car month after month, do I lose some of the insurance, whether I use it or not? Yeah, that bubble around my car and I gets a little bit smaller because a month has gone by. So when we use up insurance, we have to adjust for it. So like, let's say I buy a $3,000 auto insurance policy. At the end of the year, it might be sitting there at zero because I used it all. Okay. Supplies, I might buy $5,000 worth of pens, pencils, paper, and at the end there might be $1,000 left. Have I used $4,000? Yes. And so if I would go onto my balance sheet and say I have $5,000 worth of supplies still, that's not true. That's not accurate. And that's why we have to have adjusting entries. We pay for those up front when we get them, and as time goes by, they just like kind of chip away as we use them. I'm going to switch pen colors. Advertising and rent are what? Expenses that show up on the balance sheet. If I say, hey, Stevens County Times, run this ad for the next 6 months, every time you print the paper, I'm going to pay for that up front, and as the months and as the weeks go by, my prepaid expense will be used. Same thing with rent. If you pay monthly rent every month on the first of the month, you live in that place or run your business in that place. As you use up that rent, the event happens. Now the one that's kind of confusing on here is depreciation. Depreciation relates to equipment. We'll spend a whole chapter talking about depreciation. It's actually a contra asset. Every month that goes by, my stuff depreciates in value. My computer's not worth as much. My TV's not worth as much. My car, my Suburban, my lawnmower, all that stuff loses value. And that's what's called depreciation. okay? So anytime there's money on the front end, right here, and we buy these assets or we pay these expenses, as they happen, they become an expense that we need to account for. Hence the name prepaid expense, because we pay on the front end and then we use them, okay? Why do we adjust them? Because these assets have been used. I know that seems really obvious after I've been here explaining. This is the confusing part. This is a little accountant screaming. For the first time, you're exposed to what's called overstated and understated. And I know my previous classes were always like, I don't get this. Because it's like one of those economic type things that's so easy until you try to start explaining it, then it all of a sudden becomes hard, okay? If we didn't adjust, here's the beginning, here's the end. If we didn't adjust, like if this end didn't happen, would it look like our assets are overstated? Or would it look like we have more assets than we really do? Yes, because 4,000 pencils are gone because we used them. So this means if the adjustment wasn't recorded, we didn't do it, our assets would be overstated. It would look like we have more than we really do, because remember, this is all in paper. The accountant's world is all in paper. We have financial statements, and if we didn't adjust, man, it would look like we have 4,000 more pencils than we really do. And then as a result, our expenses would be understated, which simply means it didn't look like we ate up 4,000 pencils and had that expense happen. So my previous classes looked like this. Like, oh, they just never could really wrap their head around them. And maybe for you, it's simply memorizing this. Will you have some test questions on this? A little bit, not a lot, but just know what that means. We're going to do an adjusting entry right now. So find that in the little section. Pioneer Advertising Agency. So that must be us. What did we buy? We bought supplies for $2,500 on October 5th. At the time of purchase, we recorded that payment by debiting the asset to supplies. I think, oh, okay. That's when we bought them. If I had to make a T account, and that's what I would suggest you do, supplies are an asset that we own. On October 5th, running out of space here. On October 5th, we bought $2,500 worth of them. That's what's sitting there in our balance sheet. If we didn't adjust, assets would be overstated because we are about to use some. The account shows a balance of $2,500 on the trial balance, because remember, trial balance is we journalize in the general ledger. Excuse me, I said that wrong. We journalize in the general journal. We post to the ledger. From the ledger, we pull the balances to make a trial balance. That's not the real story, because an inventory count at the close of business. So at the end of, notice I'm not saying at the end of the month. Notice I'm not saying the end of the year. I'm saying at the end of the fiscal period, somebody at our business counted, and it shows we only have $1,000 still on hand. So if I did something like this, that's our true balance. Even though the trial balance says $2,500, because that was pulled from the ledger, somebody at the end of the fiscal period counted and said, you don't have $2,500 anymore, you have $1,000. So what did we use? We used the difference, $1,500. Should I debit or credit that? We need to credit it, because if I debit, it would have to be plus. And that's not true. We have to debit it or credit it, because that's reducing it. You know enough about accounting. If there's a credit, what else has to happen? It's got to be a debit. Okay, and you also learned that if something's pulled from the balance sheet, where does the other half have to be? From the income statement, and it's called the supplies expense. Is our debit. And what went down? Supplies. So here is our debit and credit rule. And here's an income statement account. Here's a balance sheet account. There's your adjusting entry for something we bought on the front end, so a prepaid expense. And as time happens, we need to adjust. It's a deferral because the money was there at the front end, and now the event also happened. Let's do another one. Pioneer Advertising Agency paid, so I see that I'm going to paid $600 for a 1-year fire insurance policy. What's the account actually technically called? It's an asset. Prepaid insurance. That's an asset. So on October 1st, no. Oh, coverage began on October 1st. Okay, sweet. So on 10/1, we bought a $600 fire insurance policy. We're going to just call it prepaid insurance, and it's going to last us for a year. So it's a deferral because the money was there at the front. We paid our money for our 1-year policy. The deferral will happen, the events will happen throughout the course of, in this case, 1 year. Pioneer recorded the payment by debiting prepaid insurance. This account shows a balance of $600 on the trial balance. Well, of course it does, because we pulled that from the general ledger, but that's not the real story. Insurance of $50 expires each month. So the event that happened is a month went by. How did we get 50? We took our $600 insurance policy and we divided it by 12 months to find out that as every month goes by, we are going to lose $50 in value. So now, unlike this one, they told us what was at the end. How is this one different? They didn't tell us its final balance. They told us the magic number. We lost $50 of that asset as time went by, and we need to adjust for that. So what's our real balance on October 31st? Not 600, 550. So sometimes the transactions will tell you what's at the end. Sometimes the transactions will tell you what was used. You just kind of got to know. Riley. Because if you read, coverage began on October 1st. So we just didn't pay for it. It's think of us like, according to this transaction, think of it like we bought it on October 1st. Maybe it was the weekend or something. So I see a credit to the asset. Okay, let me just think about this a minute. I said two important things. I said credit and asset, which we know is balance sheet. What's the other half of the transaction have to be? It's got to be a debit, and it's got to be pulled from somewhere on the income statement. Insurance expense, and then prepaid insurance. So I see a debit, I see a credit. We know this is balance sheet. We know this is income statement. Why is it a deferral type of adjusting entry? Where's the money? The beginning or the end? At the beginning. What happens? The event over time. In this case, 1 month went by for our insurance. Okay. I want to stop and ask, what questions do you have? We're only half done with today. Remember, there are two types of transactions that are adjusted. Expenses, which we just talked about, or revenue. Before I move on to revenue, what are you wondering? Okay. So this time we're talking unearned revenue. So the money is there. Events are not. We see rent again. What the heck? Well, maybe we are the person renting. Okay, so if let's say I own the old Thrifty building on the corner. Junk by Jenny is going to move in there. For the record, Junk by Jenny is not. But let's say I was. I'm going to start a store. What's above the old Thrifty building? Apartments. I think 2 of them. And so if Ben is going to rent one apartment and Josh is going to rent the other apartment, do I have revenue coming in? I do. Rent revenue. Don't be confused with the other one. Like if they were paying rent. This is me earning rent. Okay. Magazine subscriptions. A lot of times with magazines, you'll buy a year or 2 ahead of time. If you are the magazine subscription, like if you're the magazine, that's money coming in. Customer deposits for future service. So that's like the dentist, the tooth. I'm going to pay to have my crown put in. I'm going to give you the money now, and I hope you put the crown in. Or like the wedding dress. I go pay for my wedding dress, and it sits at the store till I'm ready for it. Okay, those are prepaid things that now they owe me the work, or, you know, Vikings tickets. Okay, why are we adjusting them? They show up as a liability, and as we perform the services, then it becomes revenue. It goes from unearned revenue to earned revenue. Here we go with this one again. Ah! If we didn't do this, remember this is the if we didn't do these, liabilities would be overstated. So it looks like we owe more than we really do. And revenues would be understated because it's like we never did the work. So if I'm a dentist and someone pays me for their crown that's going to go in, if I didn't do this, it's going to look like I still owe them the crown and that I didn't earn any money for that crown if we didn't do this type of adjusting entry. So let's see what it looks like. Pioneer Advertising received $1,200 on October 2nd from R. Knox for advertising services expected to be completed by December 31st. So how many months worth did they buy? October, November, December. This R. Knox, so they're technically one of our customers, bought a 3-month, not 30, cheapers. Whew. A 3-month advertising gig with us. I don't know what we're advertising. That doesn't matter. Okay. So we've got unearned service revenue. What do we owe? What do we owe here? Advertising. Okay. This is a credit-based account because it's a liability, which you know is a balance sheet. Okay. That goes up by $1,200. Of course, the trial balance shows $1,200 because we haven't adjusted yet. But at the end of October, it reveals, an analysis reveals, the company performed $400 worth of services. Can you tell it's $400 a month? 400 times 3 is 1,200. So if they prepaid us. Remember, this is a deferral. The money's there. We're waiting for the event. Okay. 1 month of October goes by. So we've technically done one third of the work. Or in other words, $400. So kind of like that last one, they told us what happened. They didn't say, you know, $800 remains. They could have. If I had to stop and say, what's my balance? It's $800. Going back to this slide, had we not done this, had we not done this minus 400, do you see how this would have been overstated? It looked like we owe more work than we did. And it would look like we didn't have as much revenue come in. So here's the adjusting entry. I see a credit, or a debit, and I see a balance sheet. The other part has to be what? Credit income statement. So let's do the debit first. Unearned service revenue, the liability actually went down. There's our debit. There's our balance sheet. The other part has to be a credit, and it has to come from the income statement. What happens when we actually earn money? It's called service revenue. So now all of a sudden we truly have earned our revenue because we did 1 month's worth of advertising in this case. You're awful quiet. Either you're getting it or you're still not awake from a 4.5-day weekend. 4.5. You got to just think about, okay, where is it under that umbrella? Because let me see, I wish I had a clean here. So remember, we've got income statement, which is either a revenue or an expense. Balance sheet is all assets, liabilities, and owner's equity. So you got to pull from each of those areas, and it's got to be a debit or credit. Thank you, Riley, for asking that. That's it for today. Tomorrow we're going to talk this, and we're going to actually do some problems. And they're all going to be jumbled up. Sometimes the money's going to be there, sometimes the event's going to be there. So no matter what, they both involve expenses and revenue. It's just, is the money there or not?